Hey guys, Dan here. I did a 2-hour training session today, but I wanted to follow up. I didn't want to follow it up, but I kind of have to because of what the market did. So I'm giving you another video. It'll be pretty short here. Okay, if you recall, last week, I think Friday, and this morning in the training room, I mentioned that moves this low in these key breadth indicators, like the percentage of stocks above their 200-day moving average. When they get this low, they tend to lead to a rally. Even like this low here in December led to a rally. This low led to a rally. So we're just kind of waiting to see when the low is, because if you're just looking at this and saying, oh, looks pretty low to me, well, kind of went a lot lower. So we want to wait for some kind of a snapper. And, frankly, because the market's so sold off, and I'll show you the charts in just a second, but I want you to think about this. Ran up 1.3%, so the percentage of stocks above their 200-day moving average ran up over 1%. That's not a huge amount, but it is a move higher. And I haven't seen, in recent history, these situations where the breadth has rallied just a tiny bit and then fallen back further. This typically, I'm sure there's some exception, but so I'll just say without exception, almost without exception, this kind of a move higher signifies some buying in the market that's probably going to last a while. Same thing here. With the percentage of stocks above their 40-day moving average. This jumped up almost 5%. And so I look at these, you look at all of these pullbacks, all these steep bottoms in breadth, and they don't give you a fake out like some stocks do. So I believe that this is probably, I'll say it, this is a tradable rally in my view. And that's what I'm doing. So if you look at here, you can see on the weekly chart, the percentage of stocks above their 40-day bottoms just about where it typically does. T2107, still going lower. However, again, this kind of move. So let's look at we'll look at the stocks that I mentioned in the webinar and in my emails. So, here's the 1-minute chart. Here's the 5-minute chart. We're after hours here. The S&P is still moving higher. Still moving higher, and that, in trading parlance, is known as a good thing. When it moves after hours in a positive direction, you're right to be long. If we look at the daily chart, this is just what you're looking for. Just what you're looking for is a gap down like we had here. This was a pretty ugly open. And then during the day, this fell another 2.5%. Okay, that's a massive sell-off. 2.5% is a horrible sell-off in the S&P. But if you look at it from Friday's intraday low, at one point, this was down 4%. This is news busting stuff here. And so when you see that, and then you see this rebound, what this is telling you is the market is puking. Retail traders are saying, I can't stand it anymore. I can't take any more pain. And they're selling. Institutions, which had been dumping all along, are kind of finally done. So it tells you that institutions which had been selling are now buying. And you can see exactly when they started buying, at 12:30. My bet is, if we look at the Qs, boom, 12:30. This is known as a program buy. Dow Jones, boom. I don't know about transports, probably. Yep, maybe. I think it took them 5 minutes longer, 15 minutes longer. So this is the kind of stuff that you look for when you're looking for climax lows. Now, we'll just stick here. This is still in a trading box. So I'm not saying this is going to move to new highs or anything like that. You have to recognize the box that this is in. Same thing like with the S&P. Hey, it's also in a trading box, but man, that's one big wide trading box. And so, I look at this and I think that this has more room to run. Is it the bottom? I think it's the bottom for this sell-off. I do. I think it's the bottom for this sell-off. Is it the bottom for the entire pullback or correction, something like that? I couldn't say that. I hear some of the guys on CNBC, I think it was David Tepper, a few other people saying, I don't think the bottom is in, but I did buy some today. So you can take that for what it's worth, but you're going to get divergent opinions on things like this. But my sense is that you just, you manage your risk, and there's, a few different sides of risk. There's the risk of losing money. There's the risk of also missing out on money that you could be making. And the way I see it is that we have switched in one day from the risk of losing money. We'd say, oh my gosh, if I'm in, is it going to go any lower? This is horrible. I'm going to have to go, take 2 jobs. I don't want to work at 7-Eleven, but I will. That's the one day. And then the very next day, when you get this kind of move like this, now the risk has gone from the fear of and the very real fear of losing money to the fear of not making money. And if you look at the intraday range here, you've got on the S&P, it's 4.4%. You're buying the SPY here. You put your stop a little bit below 420, and you've got less than a 5% risk, and you're in. You see this big volume on Friday, massive volume on Friday, and then today, even more volume. Guys, that is what marks bottoms, at least trading bottoms. Again, is it the bottom? I honestly can't tell you that, and I'm not going to try. I know sometimes people want to kind of get me. You're not really thinking about it this way, but your questions and stuff like that, you're kind of asking me to guess, and that's something that I don't do. Because I'm doing you a disservice. If I guess right, you're going to think I know more than I know. And if I guess wrong, you're going to lose a lot of money. So all I do is report this stuff and then give you my opinion. I think this move goes higher. Unless we invade Ukraine or something like that. There are so many there are so many points of uncertainty, geopolitical. I mean, that's the stuff that I would look at as something that's a threat to the market, like a geopolitical thing. At this point, frankly, and this may surprise you, I don't think the Fed can say anything that's going to drive stocks down right now. I think if they say, we're going to hike 29 times, traders are going to go, well, hell, at least it's not 30. I'm buying because all I have is cash. If they say, we're not hiking rates at all because the market's down, you're going to get a big, massive move up. If the Fed says, well, we're not real sure, you're going to get a big, massive move up because the market is oversold. I haven't seen what this looks like, but I got a feeling I know. You look at stochastics, yeah. Stocks have been kind of trending sideways, choppily, but they have been. And you look at these stochastics. The last time they were this low, aren't you loving this, by the way? Last time they were, I'm giving you permission to buy. Last time they were this low, we had a really nice move to the upside. They really haven't been this low on this chart. you know, a little bit here, a little bit here, but not as low as they were here. So this crossover, you know, looks pretty good. The Qs, similarly here. You know, they're this oversold here, you get a rally. They're this oversold here, you get a rally. This oversold here, you get a rally here. Well, what do you think? So anyway, so that's what I think about that. Now, other ways you can play it, and again, this is playing. I mean, you could do hardcore trading, but you know, you're kind of speculating here, is to do the ultra ETFs. You get double your fund. This is up 1% on the, you know, the SSO, and the S&P is up 50% or 0.5%. So SSO is a way to trade this for a little more bang for your buck. I bought a bunch of this stuff. I bought a bunch of this stuff into the close. And I'll also tell you, I had some QQQs, which I thought about, well, here's the QQQs. You know, I thought about kind of trading them. Don't pay any attention to this stuff. I don't know why TC2000 gets these false ticks. But anyway, I had been thinking about ditching them and instead buying QLD. But I looked at how much, you know, money I had as far as, you know, percent invested, what my margin would be, et cetera, and I just decided to keep the QQQs. But I also bought we'll say a substantial amount of the QLDs. So these are the ultras. So what I have is double your fund in the NASDAQ 100. I have double my fund in the S&P 500, and then, believe it or not, I actually bought just a little bit of Cathie Wood's Big Con, and I think this is going to go up too. So these are some oversold names that I do really feel like are going to move higher, just by virtue of being an oversold bounce. Beyond that, you know, I really couldn't tell you. I respect the trend, but I will tell you, throughout my trading career, I started out by missing these kind of moves. I didn't know what the hell was going on, and I got freaked out, and on some things I sold right at the bottom. And I started trading in the mid-90s, and if you look at what the market was doing there, you could just about, because I was brand new, you could just about spot where I sold. And it wasn't pretty. And then as time has gone on, with each successive sell-off, you know, I've gotten better and better simply as a function of experience. And then at the same time, because of my experience in doing this and my focus on risk, the two sides of risk, I've started to be more aggressive in these rallies like this, these snapback rallies. But what I haven't been is a true believer. In other words, if prices start falling again, then I'm going to say, oh crap, well, I'm wrong. Like, oh, I was aggressive, I took a big position, but that means that if I'm wrong, I got to take a big loss, and I don't want to do that. And so I would sell. You know, the point is that you can be aggressive on an entry, but that means, like, really, I think it's going down, but I'm not sure. And you can be really, really aggressive on an entry in one of two ways. You can take a massive position or give it a really loose stop. What you can't do is both. If you're taking a massive position, you have to have your loss, your risk contained. Otherwise, you're gambling and you're playing roulette. Don't do that. So I really like the way these things are trading for a trade. Tomorrow could be another day, but just because of the way these things, you know, because they're so oversold, I'd be surprised, again, absent a geopolitical event. And I don't think that's going to happen tomorrow, but I do think it's going to happen because we're basically telegraphing all this crap. And again, we got to have a war. Our industrial Military-industrial complex is pissed about Afghanistan, and so got to get into another war. Hey, why not Ukraine? And so you can say, well, you don't know and this and that. You're right, I don't know, but that's my opinion, and it sucks, but that is the way I feel. If it's something like that, frankly, even in that event, because we're so oversold, I could see the market even going up on that. Defense names would be good, but the point is, these, quote, wars like we had in Iraq, they tend to last a few days. We're not going to have World War III. Frankly, World War III is already being fought, and that's in cyberland, artificial intelligence. And I hate to tell you, I'm sorry, China's already won that war. We just haven't figured it out. So we're not going to get a war where a bunch of bombs are dropped and soldiers go in there and all that. I don't see that happen. But if we get that type of a news event, you're going to see some volatility. We just don't know which way it's going. However, if you just look at the market, this is when a stock is going to bounce. This chart, this is when the S&P, this is when the NASDAQ is going to bounce. It's going to come back and try to reclaim the 200-day moving average. If it does, then you're going to see more buyers come in, but if sellers come in and knock it down, then you'll probably see a move lower. But what I'm saying is, as of right now, I'm looking at this as a buy 'em, opportunity. I have to say it once again because I've been working with people for more than 2 decades, and I can just imagine the questions or what you're thinking. This is really a very, very short-term swing trade idea. It's very, very short-term. Could it lead to something more? Absolutely it could, or not. And this is like I've said, many times, every long-term position starts with a short-term trade. You're buying it at some point. Every long-term position starts as a short-term trade. And then if the trade's not working out, then you don't buy more. If the trade is working out, then you do buy more. So this is kind of an initial trade. Might go longer than a day or two. It might not. I'll tell you this, I bought a bunch of stuff after this, after this big snapback. So we'll see how this goes tomorrow, all right? Okay. By the way, again, the training session was 2 hours long. You can play it on fast version. I would suggest that you do that because one thing I know from listening to myself, I do tend to talk slowly, which is weird because if you saw me in real life, I wouldn't talk slow. But I tend to talk slowly, and our brains work faster than the mouth. Unless you lose your temper, then it's the opposite way around. So just put it on fast speed. You'll get the gist of it, but there is a lot of stuff there, okay? All right, and I'll see you next time.